Hello everyone, this is Beau Eckstein. This is an improv video. I'm just shooting this intro because I didn't know I was going to have a coaching call, but I had somebody who had booked a call with me about a month ago, and I said, feel free to book another call. I gave him a lot of good advice. He basically bought this abandoned building. It had 5 units and it needed to be completely remodeled. He started paying out of pocket for everything. He didn't finance it. He took a HELOC on his house. He paid cash for the 5-unit buildings, and he rehabbed 2 of the units. I think he put in like $170,000 to do that, and he's been going at a snail's pace to finish this. And first contractor he dealt with was basically couldn't perform because he was shopping for the best price. And this conversation that you're going to watch now, we talk about all this. We also talk about the velocity of money. Even if he was going to get private money or fix and flip type of loan where it's a little bit higher interest rate, he could have had this whole project done within 6 months. It's now we're 2 years in and he's only got 2 of the units rehabbed and rented. So we talk about like, hey, what did you lose on this by waiting and just piecemealing out of pocket? You're much better off if you spend an extra 10 or 12 grand in interest. Big deal. You lost $160,000 in potential rent income. So we have to look at this. It's not always the rate. I always tell people this. When I was flipping houses back in the day and I didn't have much money, I would partner with a contractor and a money partner so I could do the deal. I wouldn't have to put much of my own capital, if any, in the deal. And I didn't care that I had to give up 40 or 50 or 60% of the deal because I wasn't able to do it. So you got to look at money at a different perspective. Same thing with SBA financing. Right now, it's not cheap with Wall Street Journal Prime being at 8.25. But if I can buy this cash flowing business today and it's going to debt service and produce a lot of cash flow, the interest rate I'm not so concerned with, if you get what I'm trying to get at. So in this call that you're going to see in a few minutes here, we're going to kind of discuss some of the breakthroughs. I also recommended that he read the book, 10X is easier than 2X. Him and his wife both read the book and they're growing. Now they have a business that they might acquire. So this is an interesting conversation, and I figured even though the quality of this video that you're going to see isn't the best, I think the content is really good. So I want you to tune in and enjoy. And like I said, there's a calendar link below. I'll give you a 15-minute strategy call. We can talk about acquiring a franchise, scaling your real estate portfolio, buying an existing business. I'll give you some good insights. So I wanted to share, the discoveries that this gentleman had and how I can help you too, most likely. So anyways, tune in and enjoy, and I'll see you on the inside. All right, Rob, thanks for joining us on an improv investor financing podcast. Rob's got a lot of good questions, and he was willing to share some of his questions so everybody can learn something out of this, and hopefully I can give you a good answer. All right, Rob, dive in with your first question.
Sure, yeah. So the first, we're talking about buying a cash flow positive business. I had a really good opportunity. This guy came over, he's about 65. He spray foam insulated my floors, and we just got to talking. We had a really good rapport. He's like, yeah, I'm looking to get out of it. And then I just started thinking like, this should be my first business that I acquire. But then I started thinking, it seems like it's a good cash flow positive business. This guy's been doing it a while, 35 years. He's got a good name. How do you go about confirming whether this is an acquirable business? Do I call up him in a second, or like, what's the process like for doing that?
Sure, great question. So I would say, hey, I'm definitely interested in taking a look and buying the business potentially. Obviously, I got to make a decision based on numbers. Do you have any idea what you'd be willing to sell it for? And also, can you provide the financials? I would most likely be getting SBA financing, and they would want 3 years of your business tax returns and a year-to-date interim statement. And then, so you're having this conversation. I would first sweeten up the conversation, small talk, build rapport, and then just, say you're interested. And if he's not willing to provide tax returns at the moment, figure out, does he have a business entity or is it a sole proprietorship? What's the structure of it right now? But just tell him, when I go to get financing, I'm going to need your financials and specific your tax returns for the business for the past 3 years and an interim year to date. I think that's where I would start. Find out how many employees has. I actually have I got this from another course that I study, so I'm always studying too. I got kind of like a questionnaire and some questions you might want to ask. And I would be happy to provide that to you. General questions in the beginning are fine. You're going to come up with a checklist of things you need. He'll provide a balance sheet. Does he, what kind of equipment comes with the business? Is he paying lease for space, or did he just, use his house as storage? What kind of equipment do you need? So this business, he does spray foam insulation in houses, right? Residential?
Yeah, it looks like he just hose a trailer that has like this big spool for the hose, and it has the product in there, and he just goes in, half-inch holes, hooks the hose.
Yeah, so he's drilling holes, spray foam installation. And I'm assuming where you're located, a lot of the housing stock's older, so this is probably a pretty good service to offer. There's some franchise concepts that we work with that do this specifically, and this is a little bit different because it's a non-franchise business. It's his own business. He's acting as the owner operator. You're not going to act as an owner operator. You're going to act as an owner investor. So when we're factoring in our projections, your who is manager or the owner, you're going to get a partner potentially that could own a small portion of the business that actually does the day to day, and then you're going to just work on the business. And then you're going to find out too, do you have a CRM of your past clients? What are you doing for marketing and advertising? You might have a website. That's going to be all kind of property that's going to transfer over when you purchase the business. But I do think it could be a great opportunity. At least it's definitely worth exploring. But at the end of the day, you don't want to buy another job, right? Because you already have a job. And eventually, hopefully, this business grows and then it replaces your W-2 income. And that's perfect. But it could be 3-5 years down the road. Or you could just keep it the same way and it spits off a bunch of cash flow every year and you're spending 10 hours a week running the business. That would be ideal.
Okay, those are great things. And then do you have a sweet spot as far as what that income or the year to date or 3 years should be? Or is it just a matter of what the asking price is to what it's bringing in? Like there's a ratio, or how do you look at that?
Yeah, so if we're going to SBA, we're going to spread the financials. Bankers mostly do this, but we're looking for debt service coverage ratio of at least 1.2. Minimum is 1.15, but 1.2. But really, we want something that's going to debt coverage like way more than that because you're buying this for cash flow. So even with the cost of SBA financing right now, you're going to get a 10-year term on this business acquisition. We're probably going to have the seller carry back a big chunk, because we're going to have them carry back below what the interest rate is. So it kind of gives you a better blended rate. And maybe in a perfect world, you might not even need SBA financing because they'll carry the whole thing. And that could be an option too, where, hey, I'll come in with 10% and you carry 90. So we can create something that works, but you still got to start with cash flow now. How long, what assets he has, what kind of inventory, what will you have to replace? You're going to have to get a truck to pull the trailer. Who's gonna do the spray foam installation? What licenses need to transfer? Do you need any kind of contractors type of license to do this? How are you going to train the person to do the spray foam? What do you look for in a handyman that you can bring on the team? What kind of insurance are you going to need? What does that cost? You're going to start breaking it down and going, okay, well, what are the costs? Get the business going and the transfer. I'd be laying out all of that. And there's some checklists we have. And then there's some good pro formas too online where you can plug in all your numbers and you can kind of use that almost like a deal analyzer for a fix and flip. Same kind of principle. We have little Excel spreadsheets like that too. Real basic. But so then I would be doing all this stuff and asking the right questions, building up your list of questions. We'll give you a template and then, adding in additional questions that you have. And if the business seems like it's a good fit, then you're gonna find an attorney that closes business transactions to draft up the purchase and sale agreement and help you close, the deal. And then obviously, then you're gonna talk to your CPA and go, okay, how do I want to own the business? Do I want to own it in an S corp, C corp, LLC? What does it make the most sense from a taxable consequence? And I think once you answer those questions, you can see if it's a business you want. I think the big thing is is this a business that you can put somebody else in to run the day to day and still make a good profit and leverage it as much as possible, meaning putting a little as down as possible. Then to me, it starts making more sense because you don't want to go and put $100,000 into it and then miss out on the next real estate opportunity.
Right. That makes a lot of sense. Okay. So that's some homework then. Find out, get the basics on that first and then start worrying about financing it and if it can be run day to day. Okay, that's good. So I took your advice the last time we spoke about, going to credit unions to finance a construction loan for our 5-plex. And or it's a duplex, a 5-unit duplex. And this is the best one that I think came back to me. A guy from First Commonwealth Bank. I don't know if you ever dealt with them, but he gave me 2 options. He said, some of the details here on the loans. It's a 20-year loan, fixed rate starting as low as 6.5% APR with a 5-year reprice, meaning every 5 years, the rate can adjust to the market. The loan amount can be as high as 75 to 80% LTV. I'm guessing that's the value of the house. No escrow in payment. So that's around a $1,500 fee. Ballpark for costs and bank fees is around So on a 300,000 loan, we'd be looking at about $1,500 in fees. He said other little taxes and miscellaneous fees may apply. That's kind of abstract. And then this loan is required to cash flow on its own with the leases of the building. So an example of a 300K loan at 6.5% would be the first 5 years payments would be $2,200 a month. Does that seem reasonable to you, or does that seem
Yeah,
like
no,
whack?
that's why I gave you the advice. So the backstory for people that are going to watch this, Rob's been paying out of pocket. He found a really good fixer, and it's a duplex, but they're carving out and creating 5 units, which is going to be a complete cash cow. It's taken them a long time because they're just paying out of pocket, and basically they owe very little on an asset that when it's fixed up, it's going to be worth a lot more. So I was telling him, obviously I can do my bridge type of loans, but I said, listen, cheapest cost of capital is to go to a credit union to do this type of smaller deal. It's a smaller deal. And so what you just told me, I would say is a great deal. So what I would clarify with the credit union or the bank is, here's our in-place rents right now. Are you going to go off our in-place rents or our rents when the property's stabilized, meaning it's totally fixed up? Clarify that, and then send them those details, and then have them provide you a detailed say, what do I need to get a term sheet from you, and say, I'll send you whatever you want. Sounds like a good deal. I'm interested in doing this. I would send them a detailed email. This is our underlying debt. This is what we bought it for. This is what we put in to date. This is the remaining construction budget of what needs to be happened. 2 out of the 5 units are rented. Here's the monthly lease rent for each of them. Here's our annual taxes. Here's our annual insurance. So can you put a proposal together? I can provide my tax returns or whatever. I just want a written proposal so I get a clear understanding. But this sounds like a deal I want to pursue. I just want to give you the full story so you know that these 3 units need X amount of work. And are you going to hold that 200 grand as a construction reserve and fund as we make progress on a percentage of completion? What he's telling you, if they can do that, is exactly why I told you what I did, because that's good. Right. Then instead of taking another year to finish the project, you get it done in the next 4 months, and you replenish some of your cash reserves, that's sitting around. Now you have some of your money back where you can go buy another project or buy this business, which could potentially spit off a ton of cash flow. So this is why 10x is easier than 2x. This is exactly why.
And another thing too is like the people that allows, when you start getting in your frame of getting those big loans, the people you're speaking to, like they know architects and they know people zoning, rather than like the contractor I was talking to before when we were trying to bootstrap anybody. They don't have any sort of ins in the whole industry. It's just like, it seems like the echelon of people that I'm talking to now, it just seems like we're already making progress getting there. So that's a really good feeling too.
Yeah, and that's another. I mean, I've learned this the hard way too. Is that initially Rob had like a poor contractor that gave a good quote but couldn't fulfill and really cost more money. So the best thing to do is to find a contractor. When they come walk a property, they're diligent. You ask them when they can turn around a construction line on a budget with a scope of work, and they send it to you. And that's like the first step. If they can't do that, then you probably know they're probably not a good contractor. Paying a little bit more for a mid to high grade contractor versus hiring somebody that, because they're a handyman, you think you're going to save money. You end up paying way more, because Rob's project could have, if he would have just started from the start to finish, instead of it, he's at like year 2 right now because he's just doing a bootstrap and paying out of pocket. If he would have even had a more expensive cost of capital to get the project done and hired the right contractor, he would have been done. 5 units would have been fully rented, and his cash flow on this property is, probably most people's monthly salary. So it's substantial. So that's how you're supercharging. Because oftentimes we think that we need to, be tight, which we do, but this is an example. If you would have borrowed money at the right time, and I get it, it's good to be conservative in a lot of ways, but also I think when the outcome is that you're going to have $8,000 a month of cash flow versus, and it takes you 5 months to get there, even if it costs you 10 grand more or 20 grand more to finish, you're making that 8 grand a month quicker. So that's why you got to find the right players. And sometimes it stings a little bit when you get a contractor that's good, because their pricing is going to be more or less what it's really going to cost. And we think that the other contractor is going to save us 50 grand, but it really doesn't.
Yeah, no, we've lost 160 grand. Almost would have paid off the entire cash cow right now. So, but better late than never. So we're getting into that. And then the last one I have for you, Beau, now, you know, we're in this mentality, things are going well. We see this chunk of properties come up on sale yesterday, 49 units in Lawrenceville for 8.75 mil, with a 565,000 NOI net and a 6.5% cap rate. You know, I look at that and I go, okay, that's our next move. Now, is this a typical mistake that people in my position make by just trying to bite off too much too soon? Should I finish this project off right now with the 5 units, build up some equity in that, and then find a deal like that? Or do you think like, hey,
I mean, I guess the question is this on this portfolio, you know, we got to get the rent roll, existing rent roll. What kind of improvements need to be done? What kind of deferred maintenance needs to be done? Are they all occupied? Are there some that are complete garbage that you're going to spend time renovating? Because that's really going to affect your. I mean, if it was a turnkey portfolio, and really it's somebody bought it and they fixed them and like it was their baby, and now they're going to make a profit, and you can negotiate a good deal, and like day one, you have a really good property manager in place, and you know you've thoroughly walked every property, that could potentially be a good deal. Now the question is you know, how much capital will be needed on that big of a purchase, and then where are you going to get that capital, and or can you get some friends and family that want to own a small sliver of this package, less than 20%, but they put up some of the capital, and you know, get creative with how you structure that, and you come in with a little chunk of money, and the rest of the equity is brought in from your other partners, would be ideal. And then, you know, who's managing it now, who will manage it when you acquire it, and then, you know, that many houses, it's really a component of like the age and stock of the houses, because if it's older housing stock, even if it's been remodeled recently, we know that, you know, the maintenance is going to be the big thing that will eat you alive. So then you would, you know, ideally, if you're buying that big of a package, you're going to build your own handyman team. You might have somebody do the management, but I wouldn't let them do the maintenance. I would have your own person that you know, like, and trust, because the maintenance, I know my little portfolio in Indiana, the maintenance every week, you know, they call the maintenance department at my property manager. They go out quickly, because these property managers make the majority of their money from these maintenance calls. That's where their margin is, even on materials. So you got to see with these property management companies, hey, are you marking up materials, or are you just charging for labor? What are you charging per hour for labor? You know, what's written in the lease agreement? You know, there's certain things you can put in the lease agreement that will protect you, you know, so the tenant's not calling nonstop to get little things fixed, which end up sucking all the cash flow away. So the question is like, is that too big of a project to take on? I think I would say it depends. Like, you know, I wouldn't put yourself in a position where you're putting all your savings into something, but if you could figure a way where, you know, you could put a relatively smaller chunk and then bring in some other investors, and then I think that would probably be a way I would look at it, because I wouldn't want to put all my money. I want to keep enough in reserves, and then figure out what the maintenance needed on these units would be, and then who would manage the property. Would you have your own management team? Then, you know, do you have the skill sets to be a manager? Do you want to be a manager? I would probably outsource that. At the end of the day, you want to try to be as passive as possible, because you just don't want to buy a job where you're going out and having to fix 60 properties and deal with all that stuff. But it could be a good opportunity. That's the way I would look at it.
Right.
That could potentially be your new job, and you quit your job if you wanted, right? Thinking from the book that you read, 10X is easier than 2X. The other book they wrote was Who Not How. So if you're doing that, who's going to property management? Who's going to be your maintenance person? Who's going to come up with the equity? That's what I would be looking at. And I think if I would buy that big of a portfolio, I would have my own maintenance company. Probably not management company, but I'd have my own maintenance guys. And that would be part of the deal because that's where you're going to lose your money.
On that note of financing, is there any way to do it without pulling in money from other people, like either seller financing or a gap loan, or have you been able to do something like that with not too much of your own capital down?
Well, we have portfolio loans that do loans like this. Let's just say their properties are all in decent shape. They're all rentable, habitable. Maybe there's a few vacancies. So we're going to look at the global debt service coverage ratio. You might be able to get as high as 80% of the purchase price. And then, the questions then is we need 20% plus closing costs on $8 million. Can we negotiate the seller to carry back some? Let's say we get them to carry back 10 or 15% and we come in with 5%, that becomes more feasible. So then what lenders will be okay with subordinate financing, meaning subordinate means leaving a second in place from the seller. So most likely it probably wouldn't go to a portfolio lender. We'd probably take it to a credit union or regional bank that likes rental property portfolios and then negotiate seller financing. And then we need $400,000. If we structured an 80% bank loan, 15% seller carry, and then 5% equity injection from the sponsors or the borrowers. So that's still 400 grand. And then that could now, coming up with 100 or 2 on your side and then bringing in just a silent money partner for the other 2 might be an idea.
Okay. Yeah. I like that. So is that all initiated by contacting the seller personally and saying, hey, is this something you guys would be up to?
Yeah. First I would start with getting a copy of the rent roll and then, asking who's managing it right now. Also ask for a copy of a trailing 12-month profit and loss statement. And then they'll usually have a schedule of real estate owned, an REO schedule, and it will show when they bought it, square footage of the property, what's the rent, is it occupied, what are the annual taxes, what's the insurance, and then that will come on in like an Excel spreadsheet. We get that. We see if they have a T12 they would provide, which is trailing 12-month profit and loss. Figure out who they're, and then I would drive a handful of the houses, initially, and then maybe all of them once you get further down to due diligence, and then eventually you would probably get an inspector to inspect all of them, set fee, or at least cherry pick a bunch of them to inspect, because find out that 10 of these or 15 of these houses need new roofs. So you want to figure out what that deferred maintenance is really going to cost you once you take over that, because that's what kills us. Like if you buy a property and that same year it needs a roof replacement, it's $8,000. That takes all your, it's a single family home, let's just say. That's all your cash flow is gone. You lose money that year. And that happens to everybody. Well, at least some of us. When you have that many properties, that's where you can lose your shirt, because then it's like, whoa, I didn't know we needed to do sewer lines are bad. We got roofs that are bad. So it's a big undertaking, but in the day, if it was a really good deal and the guy was motivated to sell and he's willing to carry back, and sometimes they're willing to carry back because they don't want to have a huge taxable consequence. So they're willing to sell on an installment sale. So they only pay tax on what actually for that year. So then they pay less in taxes for those years, and they can do some more kind of estate planning.
Okay, that's an option too.
Yeah, that's what I would probably look at doing. But yeah, anything's possible. Do that. It's a bigger undertaking, but I think it's definitely possible.
Responding to credit union is the thing I'm most confident in right now to get that construction loan and move forward with that, because we're happy with that property. We think it's going to be a great investment. As far as a small business for the insulation.
Yeah, I agree. That's good. You bet. Well, we'll wait till our next coaching call. I look forward to seeing your progress. Hey guys, Beau here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.